In chapter 3, we're going to talk about forward contracts, and we're going to spend a lot of time using this no arbitrage pricing concept to figure out what is the fair forward price. But before we start our discussion of forward contracts, I want to spend a little bit time talking about short selling assets. That's because many times when we build an arbitrage strategy, we do have to short sell an asset. Let me start with an example of Tesla shares. Let's say Tesla shares are traded at $300 today. And let's suppose I would like to make some money from a decrease in the Tesla stock price. How can I do that? Well, let's suppose that you own Tesla shares and you're planning to keep it in your portfolio for many more months. And so what I can do is I can approach you and I can ask you, could I borrow one Tesla stock from you for 1 month time? Now for you, it doesn't make a difference whether that stock stays in your portfolio or you give it to me for 1 month if you know for sure that I will really return that. In other words, if there is no default risk. Now, once you lend me the Tesla share, I would sell it in the market for $300 and then I wait 1 month. Let's suppose now that the Tesla share price drops to $250. Then after 1 month, I can buy this Tesla stock again in the market for $250 and then return it to you. Now, what does this mean? Initially, when I sold it, I received $300 in cash, and now after 1 month's time, I only have to spend $250 to buy it and return it back to you. That means I earn $50 on that drop in the Tesla stock price. On the other side, of course, if the Tesla stock price would increase to, let's say, $350 after the 1 month, now I would have to pay actually $350 to buy it and return it back to you. And therefore, I would actually lose $50 from that price increase. Notice that there's one more complication. Let's suppose that Tesla would pay dividends within that 1 month. And let's say they pay a dividend of $30. Then in this case, now you're not indifferent of lending the stock to me and just getting it back after 1 month, because if you did give me that stock and I sold it in the market, then you don't receive that $30 dividend. Now that makes you worse off, and so what you would ask me to do is pay you a compensation for this dividend payment. So in other words, as soon as Tesla pays out its dividends, which you don't receive anymore because you gave the Tesla share to me and I sold it in the market, then I promise you to pay you this $30 dividend as a compensation. Let's look again at our example. Let's say the Tesla share was $300. When I borrowed it from you, I sold it in the market, I get $300. Then Tesla pays a dividend of $30, so I have to pay you $30. And then let's suppose after 1 month, again, Tesla ends up at $250. Now I buy it back. And so what's my profit now? I'm left with $20 profit. Notice that in theory, it doesn't matter to you whether you lend me that share for 1 month or whether you just keep it in your portfolio, because again, at the end of the day, you still end up with the 1 Tesla share after that 1 month, and I do reimburse you for all the dividends. Therefore, in theory, there is no need for me to pay you any fee so that you lend me that security. However, in practice, there are typically some small lending fees. Now, these lending fees are determined by demand and supply, and from time to time, lending fees can actually be quite high depending on the market situation. In addition, in practice, lending fees are not fixed at the time when you short sell, but lending fees can actually change on a daily basis. So therefore, in practice, there is actually a little bit of risk for the person who short sells, because it could be just shortly after you start short selling, then your lending fees are going to increase. Now, of course, at that time, you can always return the share if you want. But again, if your strategy actually involves short selling for a certain amount of time and then lending fees increase a lot, then that may actually cause some problems for you. For our course, we do not want to worry about lending fees, and we do not want to worry about risks that lending fees may change. And we just simply assume that there are no lending fees at all. Finally, short selling might be quite a reasonable thing for stocks where investors just hold them for investment purposes, but it may not be such a reasonable assumption for some consumption assets where people actually hold an asset because they want to use it for something. For example, oil they want to use to produce, say, gasoline and sell that afterwards in the market, and people use it to drive a car. In that sense, when I want to short sell oil, and if I approach someone and I ask that person, can I get a barrel of oil from you? I will return it in 1 month. Then the oil producer may say, no, I actually need that oil to do something else with it. Let's look at another example similar to the example of the Tesla share, which I made before. Let's say you short 100 shares and the current price of the stock is $100 and you want to close out that position after 2 days. And let's suppose the price after 2 days is $90. So what does this mean? Initially, when I borrowed 100 shares from a security lender, then I can sell them for $10,000 in total. And after 2 days, to buy back the 100 shares and return it to the security lender, that means I have to spend 90 times 100 or $9,000. Now, let's say over this 2-day window, there is also a dividend payment of $3. That means I have to pay $300 as a compensation to the security lender because, again, the security lender does not receive the $3 dividends from the company which pays out the dividends. And therefore, that's a reduction in my profit. So what's my profit overall? So it's again the 10,000 which I get initially from selling the shares in the market, then minus the $300 in dividend compensation which I have to pay to the security lender, and then minus the $9,000 which I have to spend to buy back the shares to return them to the lender. That's then in total a profit of $700. Now let's look at what is the profit for the security lender. Well, he started with 100 shares in his portfolio. They were worth $10,000. And then he would earn these $3 dividends from holding these shares, which is another $300. But then after 2 days, the share price dropped by $10 to $90 each. That means now the shares are only worth $9,000. So effectively, that security lender had actually a loss of $700 during these 2 days. Notice that the profits of the short seller and the profits of the security lender exactly are offsetting. So it's exactly a zero-sum game. So in that sense, the person who originally owns the shares and lends it out and the short seller, they're really just taking both a bet on whether the stock price increases or decreases. Before we talk about pricing forward contracts, I want to talk a little bit about how forward contracts are traded and how they are specified. So forwards are always traded over the counter. That means you have to find another party who you think might be interested in trading a forward contract and then privately negotiate with that party and then sign a contract. So this is in stark contrast to an exchange where when you want to trade a security, you just go to the exchange, you look at which securities are listed on that exchange, and then you just submit a bid to either buy or sell that security. Now, one advantage of over-the-counter traded securities is that they can be tailor-made. So once you negotiate with a counterparty, you can really write the contract in any way which you want. So that means that you can specify what is the underlying asset, how many units of the underlying are traded, when exactly is the maturity date, and if you want, whether parties have to put down some collateral to ensure that there is no default in this contract. This again is very different than on an exchange, where the exchange tells you exactly what kind of contracts are traded, what are their underlyings, how many units of the underlyings are in each contract, and what are the potential maturity dates which can be traded. So in that sense, over-the-counter traded contracts, since they can be tailor-made, it gives you much more flexibility. Traders in financial institutions typically have a network of dealers which they usually trade with, and nowadays traders are connected through the internet, and there are specific chat rooms set up where traders can meet and trade forward contracts written on specific underlying assets. Notice that forward contracts, because they are tailor-made and because they are negotiated between two parties, they're typically hold until to maturity. So typically you cannot sell your end of the contract to a third party. One of the reasons is because your original counterparty might be afraid that you sell it to someone who has a much worse credit risk than you. So maybe they would have entered the contract with you with the belief that you're never going to default. But if you would sell that contract to someone else, then maybe they might be concerned that that other person may default in the future. Now, at the maturity date, you can either have cash settlement or actual delivery. Most of the time, big financial institutions actually prefer cash settlement. So most forward contracts are settled in cash. So again, what does this mean, cash settlement? It means that both parties, they will look at what is the actual value of the underlying asset, which is supposed to be delivered in a forward contract. And instead of delivering, they would then just take the difference between the forward price and the actual value of that underlying asset, and then long and short position just settle in cash. So whoever has the liability pays a cash amount to the party who has the positive payoff. Default risk might be an issue for forward contracts. If you sign a contract where you take a long position and the price of the underlying increases a lot and you expect a high positive payoff in the future, which also means that your counterparty has a very big liability in the future, then there might be actually a risk that this counterparty may not be able to make the payment at the maturity date and default on the contract. Therefore, counterparties sometimes require collateral payments, meaning that as soon as the contract starts moving against you, you will be required to put down some cash in an account which will be there as a security in case you will not be able to make the payments at the final date anymore. Now, if there are collateral requirements, well, then that can actually also pose some liquidity risk. So imagine that you have, again, a long position, the price moves against you, meaning that the price of the underlying asset starts to decrease a lot. Now, of course, the counterparty may be worried that you may default, so they may require you to put down some cash. But if the price now keeps decreasing more and more, that means you have to put in more and more cash into that account to serve as collateral, and that may actually lead to a cash flow problem for you. Now, it might be that you have on your balance sheet an offsetting position, which perfectly hedges you until to the maturity date, but maybe on the balance sheet, this offsetting position doesn't immediately produce cash. And so therefore, if you have to put down collateral, while on your balance sheet, the positive offsetting position doesn't give you any cash right now, that may cause some liquidity problems. Therefore, having collateral may be not very desirable. First of all, because you have to commit some cash when you enter a position, and second, because it can lead to some liquidity problems. Finally, over-the-counter markets are less regulated, and that actually makes forward contracts quite attractive. So a lot of investors prefer to trade forward contracts because they don't want to be subject to a lot of regulation. As discussed in the introduction chapter of this course, a forward contract is an agreement to trade an underlying asset at a maturity date, capital T, for a fixed price which you specify at the time when you enter the forward contract, and we denote that by the forward price F. Again, small t over here specifies when you enter the forward contract, and the capital T in the superscript specifies when the maturity date is, when the actual trade of the underlying asset takes place. The convention in the market is to choose the forward price F such that the long and the short position in the forward contract are happy without having to exchange money today. Or in other words, the present value of the forward contract to the long and the short position are exactly zero at that initial point T. The long position agrees to buy the underlying asset at the maturity date, makes a profit if the price of the underlying S at time capital T is higher than the forward price, and the long position makes a loss if the price of the underlying is less than the forward price. The payoff of the long position in the forward contract, therefore, is just the price of the underlying at maturity minus the forward price. Again, what's the meaning here? Well, you have promised to pay the forward price at the maturity date, and you receive the underlying asset, which is worth ST dollars. On the other hand, the short position who agrees to deliver the underlying asset and receive the forward price F makes a profit if the price of the underlying is less than the forward price, and makes a loss if the price of the underlying is higher than the forward price. So the payoff of the short position can be written as the fixed forward price which the short position receives minus the value of the underlying which the short position has to deliver at the maturity date. We're going to use the following assumptions when we determine the forward price. For simplicity, we assume that there are no transaction costs. Notice that if you were to introduce transaction costs, then we wouldn't be able to pin down exactly a fair value of the forward price, but we would be able to pin down some lower and upper bound between which the forward price would have to be, otherwise there would be an arbitrage profit. The second assumption is about taxes, which you have to pay on trading profits. And basically, we want to make our life easy in this course and just assume that there's no tax rate, or we could actually assume that the tax rate is the same for all trading profits, so that in our calculations, it would just drop out in our equations, both on the left and the right-hand side. But even if you would assume that investors have to pay taxes and tax rates are different for different trading profits, so for example, paying interest on the risk-free asset versus capital gain taxes or profits realized in derivative trading, it would actually be relatively easy to adjust our formula for these kind of tax rates. More importantly, we assume that investors can lend and borrow money without limits at the risk-free interest rate. And this is clearly an assumption which is not true for small investors and maybe even difficult for certain funds. But for big financial institutions, this may actually be not that bad of an assumption. Typically, large banks, for example, can lend and borrow pretty much at the same rate. We further assume that there are at least some investors who would happily exploit some arbitrage opportunities if there are any, and they would trade as much as possible to get free money until demand and supply adjusts and these arbitrage opportunities disappear. Therefore, when we try to determine what are the fair forward prices, we will assume that there are no arbitrage profits. Finally, in the following, we work mostly with continuous compounding. However, all of the formulas which we do derive, we could also rewrite for m times compounding per year. So this final assumption is really not problematic at all. Let's start with a simple example. Suppose there is a stock which is traded at $100 today. You expect it to increase by $5 to $105 until next year. And let's suppose this stock doesn't pay any dividends. Further, we assume that there are no costs to either buy or short sell this stock, and you can lend and borrow money at a 1-year risk-free interest rate of 10% continuous compounding. So the first question is it an arbitrage to short sell the stock and use the $100 to invest in the risk-free asset, since the risk-free asset earns actually a higher return than the expected return on that stock? While this might be an attractive investment because in expectation you make about $5 per year, it is not an arbitrage because there is actually a probability that that stock price is going to end up much higher than $110, and then you would actually lose money by short selling it and investing the $100 at 10% interest. So let's now suppose we also have a forward contract in this market, and you can take either long or short positions in this forward. And the forward is written on 100,000 stocks, and the forward price is $10.9 million. So how can you make now a risk-free profit? So let's go to the virtual whiteboard and write that down step by step. Let's draw a timeline. You start at time t equals to 0, and then the maturity date is going to be at t equals to 1. Now, let's consider the following strategy where we short sell 100,000 shares. That means we get today a cash flow of $100 per share multiplied by these 100,000 shares, which is $10 million. After 1 year, we have to buy back 100,000 shares in the market to return them to the lender who gave us these securities in the first place so that we were able to short sell them. So our cash flow is going to be minus 100,000 times the current price of that underlying asset. In addition, we're going to take the $10 million at time 0 and we invest that at the 10% risk-free interest rate. This means today we have a negative cash flow of $10 million. And after 1 year, we receive back the $10 million plus interest, so that's a cash flow of plus 10 million multiplied by e to the power of 10%. Finally, we take a long position in the forward contract, which helps us to lock in the price to buy the 100,000 shares, which we need to return to the security lender. Entering the long position in the forward contract doesn't cost us anything today, so the cash flow is zero. And after 1 year, that means now we have to pay $10.9 million. That's the fixed forward price, and we receive 100,000 shares, which are worth 100,000 multiplied by the share price at time capital T. So let's look at the cash flows at time 0 and at time T1. At time 0, the cash flow is going to be 0. Well, because the $10 million which we receive from short selling shares, we reinvest in the risk-free asset. And after 1 year, we see that the shares which we need to return to the security lender, this we receive through the forward contract. And what we are left with is a risk-free cash flow of 10 million multiplied by e to the power of 10%, which is a little bit more than $11 million, minus the $10.9 million of the fixed forward price, which we have to pay. So this is going to be a positive cash flow. Therefore, we have zero cash flow at time 0 and the positive cash flow at time T1. Therefore, this is an arbitrage strategy. I also write exactly the same strategy here on the slide. Motivated by this example with this arbitrage strategy, let's try to think about what should be the fair value of the forward price such that there's no way to make an arbitrage profit. So what we want to do is we want to create an investment strategy which takes the positions in forward, underlying asset, and the risk-free asset such that the initial cost of this strategy is going to be 0 as well as future payoffs are going to be 0. So there will be no arbitrage opportunity. For that purpose, let me go again to the virtual whiteboard. Let's draw again a timeline where we start at time small t and have a maturity date at time capital T. And let's consider a strategy such that we have a 0 payoff in the future. So let's start with borrowing an amount equal to the fixed forward price discounted from capital T back to time small t. So that leaves us with a cash flow F multiplied by e to the power of minus the spot rate from small t to capital T times the number of years between small t and time capital T. In addition to that, we're going to buy 1 unit of the underlying asset. This costs us the current price ST dollars. Finally, we take a short position in the forward contract, which doesn't cost us anything today. So let's look at what the payoffs are of this strategy. So the borrowed amount of money we have to pay back plus interest. And so if I multiply that initial amount of money which I have borrowed by e to the power of the spot rate R from small t to time capital T multiplied by the number of years, that means that exactly this last term over here is gonna disappear. And what I have to pay back is an amount of dollar exactly equal to the forward price. Furthermore, the 1 unit of the asset which I have bought at time small t, I hold that until to the maturity date, and that's now going to be worth ST dollars. And finally, the short position in the forward contract means that I have to deliver 1 unit of the underlying asset, which means a negative cash flow of minus ST dollars, and in return, I receive the fixed forward price of F dollars. So adding up cash flows in the future exactly is equal to $0, while at time small t, I have the forward price discounted by the risk-free rate minus the current price of the underlying asset. Notice that because this strategy has a 0 payoff in the future, so meaning you don't earn any money in the future and you don't have a liability in the future, that must mean that the current value is also equal to 0. That's by no arbitrage. And this equation pins down exactly a formula for the forward price. So the forward price is equal to the price of the underlying asset at time small t multiplied by the return in the risk-free asset. I also show this derivation on slide 12 and on slide 13. Notice that I can also rewrite this equation, which I've just derived, dividing both sides by ST. Now, this term on the left-hand side has a nice interpretation because this is the risk-free return which you receive from investing in that asset and locking in the fixed price at which you can resell it in the future. Now, since it is risk-free, this return then has to be the same as the return in the risk-free asset. And therefore, again, you have this equality, which again is the same as the equation which we have just derived before. Now let's think about what would happen if this equation doesn't hold. In particular, what would happen if the forward price is larger than this expression on the right-hand side? Well, in that case, the strategy to borrow money, buying the underlying asset, and taking a short position in the forward to lock in the price at which we can resell that underlying asset has a positive payoff. On the other hand, if now the forward price was less than that expression on the right-hand side, well, then we can change our strategy. Instead of borrowing money, we would lend money, meaning we have now a negative cash flow today, but we receive the lent money plus interest in the future. And then we take a short position in one unit of the asset. That means we receive ST dollars today, and in the future we have to return the short sold asset, which means I have minus S at time capital T dollars. And then we would take a long position in the forward, which means in the future we have to pay the forward price and we receive 1 unit of the underlying asset. Now again, in the future, if you add up cash flows, this gives exactly 0. And now the cash flows today are going to be minus the amount which I lend plus the value of the underlying asset which I short sell. And that's now larger than 0. So you see, the only way to have no arbitrage is if the forward price is exactly equal to the price of the underlying asset multiplied by the gross return in the risk-free asset. And this argument is also on slide 14. Finally, as a side note, even if it is impossible to short sell the underlying asset, then investors who actually already hold that underlying asset in their portfolio, they still can sell that asset and run an arbitrage strategy. And therefore, a similar, although a little bit weaker argument holds. Next, we want to look at a forward contract written on an asset which actually has some cash flows between the initial date and the maturity date. Now let's consider again our timeline from time t to capital T, but now we also look at these dates S1, S2, and then potentially many more dates to Sn. And at these dates, you have a certain cash flow given by I S1, I S2, I Sn. Notice that if these cash flows are positive, then you can think of them as, for example, a dividend which a stock pays or an interest payment which a bond pays. And if these are negative cash flows, then you can think of them, for example, as storage costs. So if you buy, for example, gold and you hold the gold, you need to keep it safe. And so there is some cost which you have to pay for the safekeeping. Now, the first thing I want to do, I want to define the present value of all these cash flows between time small t and the maturity date capital T, and I define that as IT. So this is given by the sum over all time SI for the cash flows I at time SI, discounted by the spot rate between time small t and time SI for SI minus t number of years. And what we will show is that the forward price now will be quite similar as before and just needs a small adjustment. So in particular, it will be still equal to the price of the underlying asset. And we're still going to multiply by what is the risk-free return from small t to time capital T. But now the adjustment will be that we just have to subtract that present value of all these cash flows from the initial price of the underlying asset. Notice that we can rewrite this equation as the ratio of F and the price of the asset at time small t. So this would be again that risk-free profit which you get from buying the underlying asset at time small t and locking in already the price at which you can resell it at the maturity date. But in addition to that, I have the present value of the dividend payments multiplied by the gross return in the risk-free asset from small t to time capital T. And this is again equal to the gross return in the risk-free asset. Now notice that this thing over here is also equal to the return which you get from investing at the forward rate from time Si to time capital T. So what's the interpretation now of this thing? Again, the first term was what's the risk-free return which you get from buying that underlying asset and locking in the price at which you can resell it. And the second term over here says the cash flows which you get at time Si invested at the forward rate until time capital T. And again, that's risk-free because you already knew what that forward rate is back at time small t, divided by the original price of that asset at time small t. That's really the cash flow yield which you receive or have to pay to hold that asset. That thing together has to be the same as an investment in the risk-free asset from time small t to time capital T. In that sense, this formula has a very similar interpretation to the formula which we have seen previously, where we didn't have any intermediate cash flows between small t and time capital T. Notice here on slide 15, I basically write the same things which I also just explained on the virtual whiteboard. Next, I want to look at an example with numbers to illustrate where this no arbitrage pricing formula comes from. So let's consider a 6-month forward contract to buy 1,000 stocks. The current stock price at time 0 is $100, and the stock pays $2 dividends after 2 months and 4 months. Moreover, we assume that the yield curve is flat, so meaning that the 2, 4, and 6-month spot rates are all going to be equal to 5%. Now, the first question which we want to look at is there an arbitrage if the forward price is $100,000, or in other words, $100 per share. Let's go again to our virtual whiteboard. So in our case over here, we say that these dividend payments are $2 each, and they occur at time 2 months and 4 months, and then the maturity date is after 6 months. So the present value of dividends is going to be the first $2 discounted at the 2-month spot rate, which is 5% for 2 months time, plus the second $2 which you receive after 4 months discounted at the 4-month spot rate, which is also 5% multiplied by 4 months, which is $3.95. Then according to our formula, the forward price should be 1,000 shares times $100 per share minus present value of dividends multiplied by the risk-free return over 6 months. The 6-month spot rate is 5% multiplied by 6 months, which is $98,481. Now notice that in the first question, we suppose that the forward price is $100,000. So therefore, the forward price here is too large compared to what our formula would tell us. So there should be an arbitrage strategy, and what we want to do now is we want to work out how can you make money. So let me go again to the virtual whiteboard and try to write down such an arbitrage strategy. So since the forward price is too high, a good strategy is to try to sell at that too high price. So that means we want to buy the underlying asset and we want to lock in to sell it again at the maturity date at that too high forward price. So let's start by saying we buy 1,000 shares. That means we have to pay $100,000 today. And after 2 months, we receive $2,000 dividends and another $2,000 dividends after 4 months. And we're going to be left with 1,000 shares in 6 months. And these 1,000 shares are worth ST dollars each. Then we take a short position in the forward contract. This doesn't have any cash flow implications today or in 2 months or in 4 months, but in 6 months at the maturity, we now have to deliver 1,000 shares and we receive the fixed forward price of $100,000. And then finally, what we can do is we can borrow against the $100,000 which we receive in 6 months, meaning we borrow $100,000 discounted by the 6-month spot rate, which means we receive $97,531 today. And then we have a zero cash flow in 2 months and in 4 months. And in 6 months, we have to pay back this $97,531 plus the 5% interest for 6 months, which is exactly $100,000. Now, we still don't have an arbitrage because, again, the cash flow at time 0 is not yet positive. So what else can we do? Well, we can also borrow against the $2,000 which we receive in 2 months and the $2,000 which we receive in 4 months. So we're going to borrow the present value of these amounts. That means we borrow $1,983 today and have to pay back $2,000 after 2 months and zero cash flows thereafter. And we receive $1,967 today and have to return $2,000 after 4 months and zero cash flows otherwise. And now if we add up everything, then at time 0, we receive $1,481. Then in 2 months, we receive nothing. In 4 months, we receive nothing. And at the maturity date, we also for sure have a zero cash flow. So this is an arbitrage profit because, again, we get money today and we never have a liability in the future. Now, the $1,481 turns out to be exactly equal to the $100,000 forward price, which I can lock in, minus the $98,481. That's the forward price which we should have according to our formula. And because that would be a payment which you receive in the future, we discount that by the 6-month spot rate of 5% for 6 months. And notice you can use exactly the same arbitrage argument for any forward price, which is larger than $98,481. The only thing which you have to do is to adjust the amount which you borrow over here to make an arbitrage profit. But you see that as long as the forward price is above this amount, you will get a positive cash flow at time 0 and the zero cash flows for sure in the future. Notice that the solution which I have in the slides is slightly different than the solution on my virtual whiteboard. In the slides, instead of borrowing against the $100,000 forward price and separately borrow against the $2,000 dividends, which I receive in 2 and 4 months, I use forward rate agreements to invest the $2,000 dividends from 2 months until to the maturity date and also starting in 4 months until to the maturity date. And notice that the forward rates are also 5% because the yield curve is flat. And then I borrow against that entire amount of the $100,000 which I receive through the forward contract and the reinvested dividend payments until to the maturity date. Eventually, it's going to give me exactly the same cash flow. I'm still going to receive $1,481 today. And again, in the future, I have zero cash flows. Next, I want to look at another situation where the forward price is less than what we have calculated according to our formula. So in particular, we want to look at a case where the forward price is $95,000. So let's do that again. Now, since the forward price is somewhat too low, what I would like to do is I would like to short sell the underlying asset and then lock in the too low price at which I can buy it back and close out my short position. So let's write that down. So let's say we short sell 1,000 stocks. This means we receive $100,000 today, but we also will have to pay $2,000 as a compensation for the dividends in 2 and 4 months to the lender who gave us the shares so that we can short sell them. Because remember, the person who gave us the shares for short selling doesn't receive that dividend from the company which pays out the dividends, and therefore we have to pay the dividend as a compensation to this lender. And finally, in 6 months, because I short sell, I have to buy back 1,000 shares in the market, and they are worth as capital T dollars. Then we take a long position in the forward. This doesn't have any cash flow implications today, or in 2 months, or in 4 months. But the long position means that I will receive 1,000 shares, and I have to pay the forward price for these shares. And again, the idea was, because the forward price is relatively low, only $95,000, I would like to lock in to buy the shares at that too low forward price. And now, to complete the arbitrage strategy, I have to make sure that there are zero cash flows everywhere. So what I will do is I will invest some of the $100,000 which I get today to cover the $2,000 cash outflow in 2 months. So that means I will lend a present value of $2,000 today for 2 months. And this means I have to invest now $1,983. And that means I will receive after 2 months this $1,983 plus interest, which is exactly $2,000. Moreover, I'm going to lend the present value of $2,000 for 4 months, which means I have to pay now $1,967. And again, in 2 months, there's zero cash flow, but I receive that money back plus 5% interest for 4 months, which means I receive $2,000 after 4 months. And finally, I lend the present value of $95,000 for 6 months, which means I have to lend $92,654 today. And I will receive after 6 months this invested money plus 5% interest for 6 months, which is exactly the $95,000. If I add up the cash flows, I will be left today with $3,395. Then in 2 months, I have a zero cash flow because the $2,000 which I have to pay as compensation for dividends, that's offset by the $2,000 which I receive from lending the present value of $2,000 initially. Similar, in 4 months, I have a zero cash flow. And then finally, at maturity, I have for sure a zero cash flow because the 1,000 shares which I need to return to the lender, I actually receive through the forward contract at that fixed price. And again, the fixed price which I have to pay, that's equal to the cash which I receive from lending the present value of $95,000 initially. Now notice again, the $3,395, that's actually equal to $98,481 minus the $95,000 forward price, discounted by 5% for 6 months. And notice that we can do the same arbitrage strategy for any forward price which is going to be below the $98,481. So all we have to do is just slightly adjust our strategy by lending here an according amount equal to that forward price. We're always going to get here a positive cash flow as long as the traded forward is less than this $98,481. Notice that on slide 19 and 20, I also construct a no arbitrage strategy, which is very similar. Just again, as in the previous case, instead of investing the present value of $2,000 to cover the $2,000 dividends, here I actually sign a forward rate agreement to borrow $2,000 in 2 and in 4 months, which I then pay back at the fixed forward interest rate in month 6. And then I lend at the initial point in time enough money to cover all the costs for this additional borrowing in month 2 and 4, and also to cover the expenditure which I have to pay the long position of the forward contract. However, at the end of the day, you're going to end up with a strategy which gives zero cash flows in 2, 4, and 6 months. And at the initial point in time, you receive $3,395. Now, from this exercise, we see that as long as the forward price deviates from $98,481, then we can always make an arbitrage profit, which then confirms our formula that the forward price should be equal to the current price of the underlying asset minus the present value of all the cash flows between the initial date and the maturity date, and this entire thing multiplied by the gross return of the risk-free asset from the initial date until to the maturity date. Finally, again, going back to the virtual whiteboard, I want to point out that one crucial assumption which we use in this derivation is that we know exactly at which points in time we're going to receive these cash flows, and we know exactly how much these cash flows are. Why is this important? Because we always assume that we can borrow against these cash flows at the risk-free rate. If there was some uncertainty about the exact point in time or the exact amount of cash flows which you receive, then this argument wouldn't work anymore. Next, I want to consider an asset which doesn't pay at discrete points in time, some discrete payoffs, but I want to consider an asset which pays a payoff flow or a yield. And we're going to denote that yield by Q from small t to capital T. Now, this yield or this Q variable that describes a percentage of the underlying asset's value which you receive or have to pay on a continuous basis. Notice that if Q is positive, that means you receive a payoff. If Q is negative, then again, you can think of this as a storage cost where you actually have to make a pay. Now, to illustrate how this works, let me go to the virtual whiteboard again and draw a timeline. So we start at time small t, and eventually we want to end up at time capital T. And so what I want to do is I want to look at small time steps. Let's say at time small t, I start out with an asset which is worth ST dollars. And now at time t plus a small time step, let's denote that by dt, a very tiny time step. And maybe for illustrative purposes, we can think of dt as, let's say, 1 trading day. So we have 1 divided by 252 trading days per year. And let's say at that day, the price will be ST plus dt. Now, at time small t, we do not know what this price will be. There's some uncertainty about that. But what we will know is that the dividend which you receive at time t plus dt will be just proportional to that stock price. And let's just, for simplicity, denote it by Q and drop the time indices small t and capital T. And so what we say is that Q is like the annualized yield which you receive. So I multiply that also by dt for that time horizon. Or in other words, if dt again measures 1 day, then I would take my percentage yield and divide it by 252 trading days. And that's the yield of the current stock price which I receive at that particular day. And I multiply this by the current price of the asset. Notice that when we are back at time small t, there's some uncertainty about how big this dividend is because we don't know how big the price is going to be of the asset. Now, what does this mean? Well, if we would say that we use these dividends to buy new units of that asset, then how many new units can we buy? Well, we can buy the amount of cash which we have divided by the price per unit which I have to pay, which is exactly equal to Q times dt. So that's the new number of units of the asset which I can afford. So what does this mean? If I reinvest my dividend, if I start out with 1 unit, then after the first time step dt or first trading day, I can increase my position to 1 plus Q times dt units. And again, this is just done by reinvesting the dividends which I receive. Now going forward, I can take another time step to t plus 2 dt. At that time, the price of the asset will be ST plus 2 dt, and the dividend payment will be Q times dt times that current price of the asset at time t plus 2 dt. Now notice that at the point t plus 2 dt, I actually have more than 1 unit of the asset. In fact, I have 1 plus Q dt units of the asset. And so I do get paid dividends on that entire amount. So I have 1 plus Q dt times that dividend payment at time t plus 2 dt. That's the cash dividend which I receive. And now if I ask again, how many new units of the asset can I afford? Then I divide that again by the price at time t plus 2 dt. And you notice that this is now again equal to 1 plus Q dt. That's number of units which I have, multiplied by that percentage which I receive of dividends, QDT. That means that my position grows again from 1 plus QDT by another 1 plus QDT times QDT units. Notice that I can rewrite that as 1 plus Q times dt to the power of 2 units. And you can keep going like this and always keep reinvesting dividends. And you notice that this looks very familiar. It looks like getting interest paid on interest. And eventually, if you take the limit where dt goes to 0, and you basically can reinvest your dividends at every instant in time, then you're going to end up with the formula e to the power of q times capital T minus small t units of the asset. So again, I said there's a comparison of compounding interest. So remember, with interest payments, we said we start with $1. You get paid interest after the first time step, then you get interest on interest and so forth. And in the continuous time limit, $1 grew to e to the power of the interest rate times the time horizons. Now here it's kind of similar. You start with 1 unit of the asset, then you get dividends and you can reinvest these dividends and you grow the units of assets by a fixed percentage. And then again, from now that bigger position, you can grow it again by a fixed percentage. And so it's going to grow exponentially. And again, at this limit where you get paid dividends on a continuous basis and you reinvest the dividends at a continuous basis and keep growing your position, then our formula is going to be 1 unit grows to e to the power of that dividend Q, that percentage per year, which you get in dividends, times number of years over which you reinvest dividends, number of units of the asset. So what does this look like? If you have that time horizon, capital T minus small t, if you start with 1 unit, then you have this dividend yield, you reinvest dividends and more, this grows exponentially until to time capital T minus small t. Here you have e to the power of q times capital T minus small t units. Notice that the same argument also works if q was a negative number. Well, then instead of receiving cash, which you can reinvest, then you actually have to make payments. So this thing will be negative. And how can you make these payments? You can make these payments by selling this percentage of your current position. That means afterwards you still have 1 plus q dt units, but q is a negative number, so you actually have afterwards less than 1 unit, okay? Because you sell a little bit of your initial position to cover that negative cash flow. Now this growth is also going to be exponential, but of course now as you sell more and more units, the smaller these percentage cash flows are going to be, and so that decrease exponentially will become smaller and smaller. So here again, the formula is the same, e to the power of q times capital T minus small t. But again, in this case over here, q is negative, while in this case over here, q is positive. Once we have established that, we can derive a similar formula as before, where we said the forward price is going to be the price of the underlying asset. And now instead of subtracting the present value of dividends, we're going to discount this price of the asset by the dividend yield, so multiplied by e to the power of minus q times the number of years. And then again, we multiply this entire thing by e to the power of the risk-free rate, so how much the risk-free asset earns from small t to time capital T. We can also rewrite this formula again in the following form down here. So we take s on the other side, take natural logarithm to get rid of the exponential function over here, bring q to the other side, and what do we have left here? Well, this ratio is again the perfectly hedged position of buying an asset and locking in the price at which you resell it in the future. Now, taking natural logarithm, what it does, you convert this gross return into a continuously compounded return. And on top of this continuously compounded certain return, you add the dividend yield which you earn between small t and capital T. And this entire thing is a risk-free investment, and therefore it should be the same as the continuously compounded risk-free interest rate which you earn from small t to time capital T. So even though this argument here is very intuitive and then recovers this formula over here again, I want to go to a more formal derivation again to my virtual whiteboard. I'm going to draw again a timeline from time small t to time capital T. And what I want to do is I want to construct again a strategy which pays for sure nothing in the future. And therefore, by no arbitrage, the cost of that strategy has to be zero. And we're going to use that again to pin down the forward price. So what I want to do is, as in the beginning of this chapter, I want to start by borrowing an amount equal to the present value of the forward price. So this means I receive right now this amount of cash. And moreover, at the future date, I will have to pay back exactly an amount of cash equal to the forward price. Further, I'm going to buy the underlying asset, but I'm not buying 1 unit of it, but I'm buying e to the power of q times capital T minus small t units. This costs me today the number of units which I buy multiplied by the current price of the underlying asset. Now I'm going to hold on to that position and I keep reinvesting dividends. And what does this mean for the future? So I'm going to have the initial position which I start times by how much my position grows, which turns out to be exactly equal to 1 unit times the price of the underlying asset at the maturity date. And finally, I assign a short position in the forward contract, which doesn't cost me anything today. And in the future, that means I promise to deliver 1 unit of the underlying asset and I receive the promised forward price. Now, what are the cash flows? Well, in the future, I have to pay back an amount of money equal to the forward price from the money which I've borrowed initially. But I receive exactly an amount of money equal to the forward price from the short position in the forward. And then I have to deliver 1 unit of the underlying asset. But that's exactly what I have because initially I bought this many units of the underlying asset, which after reinvesting dividend grows exactly to 1 unit at the maturity date. So this means that in the future, for sure, I'm going to have now a zero cash flow. How about the time small t? Here I have that present value of the forward price minus the value of that e to the power of minus q times capital T minus small t number of units of the underlying asset. And again, by no arbitrage, because this strategy has for sure a zero cash flow in the future, then this cash flow today should also be equal to 0. And this pins down the forward price, the price of the underlying asset at the initial point in time, discounted by the dividend yield, and this entire thing multiplied by the return of the risk-free asset. Notice that, again, any deviations from the equality over here will lead to an arbitrage opportunity. In particular, again, if the forward price is larger than this formula over here, well, then we would just borrow money, buy assets and reinvest dividends and take a short position in the forward contract so that we get this positive cash flow. If the forward price is less than the right-hand side over here, well, then we lend this much money, we short sell this many units of the asset, and we take a long position in the forward contract. I also provide the same argument as on the virtual whiteboard on slides 22 and 23. So the question remains, why are we actually interested to look at an asset which pays a yield instead of fixed payments at fixed points in time? Because in reality, if you hold a stock, dividends are paid at specific points in time and not on a continuous basis. Similarly, a bond pays interest rates at specific points in time. And also, if you hold some commodity where you have to pay storage costs, then these costs have to be paid at specific points in time. So then what are we actually imagining here with this flow of payments? Well, first of all, you can think of it as an approximation of the real world. And this makes a lot of sense if there are a lot of payments and it's just really cumbersome to keep track of them. One really nice example would be if you have a derivative written on the entire stock index. So an index is actually a portfolio which contains many, many stocks. So for example, the S&P 500 would have 500 stocks in that index. And there it is clearly quite difficult to figure out what is the dividend date of all these 500 stocks, and then get really good estimates of how much dividends all these different stocks pay. Instead, what is maybe much better is to just take an assumption that on average these 500 stocks pay, for example, 4% dividends per year. And so in that sense, working then with this assumption that the index pays a flow of payment instead of discrete payments at 500 different dates 4 times a year, that makes a lot of sense. Since we talk about indices and forward contracts written on indices, it is important to note that our no arbitrage formula holds only if you can actually trade a portfolio which replicates that index. So there are a few caveats to that. First of all, there are derivatives called quantos, and these derivatives are actually written on an index, but in a different currency than what this index is actually traded. So for example, you could find a quantos derivative written on a Nikkei 225, which is the Japanese stock market index, but instead of having it in Japanese currency, you would just assume a fixed exchange rate and take the index points in, for example, US dollars. Clearly, the US dollar Japanese yen exchange rate is not fixed over the lifetime of the derivative, but nevertheless, the quantos basically wants to isolate the risks in the index and help investors to get rid of exchange rate risks, and therefore they construct this artificial underlying variable. Now, another problem with having derivatives written on the entire index is that indices can be quite large. For example, the Russell 3000 index actually contains 3,000 stocks in the US, or we have many MSCI indices which can have 1,600 or 9,000 or even 14,000 stocks from over 45 different countries. So even if you have a deviation from your no arbitrage formula, it still may not be possible to get a risk-free profit because it may just not be possible to trade all the underlying asset in such a large index. Now, of course, nowadays the situation is a little bit better because we can actually program a computer to trade, and computers can trade very large portfolios. But even then, we still face the problem of transaction costs, especially with an index which contains like 14,000 stocks of 45 different countries. There might be a lot of small stocks in this index, and small stocks may have quite large transaction costs. Therefore, in some cases, you can actually find deviations of the forward price from our no arbitrage formula, and yet no one can make a risk-free profit. Next, I want to turn the focus to foreign exchange rates as underlying assets. The spot exchange rate, let's denote it by ET at time small t, is the price in dollars which you have to pay for a foreign currency. So that means, for example, if you look at US dollar and Swiss franc, if a US retailer needs 1 million Swiss francs to pay for some goods which he wants to import, then let's suppose the exchange rate is 1.03 US dollar per Swiss franc, then this company will have to pay 1.03 million US dollars to obtain the 1 million Swiss franc. Now, in a forward exchange rate, the underlying asset is just simply a foreign currency. So the forward exchange rate is just an agreement today at time small t to exchange F dollars for 1 unit of the foreign currency. So for example, with the exchange rate between US dollar and Swiss franc, let's say the company needs 1 million Swiss franc in half year time. And let's suppose that there is a forward exchange rate contract with a forward price of 1.035 US dollar per Swiss franc. This means that if the company takes a long position in that forward contract, then they lock in the exchange rate in half a year time. And in particular, they will have to pay 1.035 million US dollar to receive 1 million Swiss franc in 1 year time. Now, the question is, if you look at this scenario where the current spot rate is 1.03 US dollar per Swiss franc and the forward exchange rate is actually higher, 1.035 US dollars per Swiss franc, why would you ever want to lock in this higher exchange rate? Well, the reason is simple. If I already exchange US dollars into Swiss francs today and then wait half a year, then my Swiss francs are gonna earn the Swiss franc interest rate. However, instead I could keep my US dollar and invest them at the US interest rate and then exchange the US dollar to Swiss franc at the forward exchange rate. So therefore, differences in the current spot exchange rate and the forward exchange rate are just going to be due to differences in the interest rate in US dollar versus the interest rate in Swiss francs. And notice that the interest rate in Swiss franc I denote by RF, where F stands for the foreign currency. So let's use again a no arbitrage argument to pin down what should be the forward exchange rate. And what I want to do again is I want to draw this timeline between time small t and time capital T. And so what I want to consider is that you have $1 today, and you can either invest this dollar at the dollar interest rate until time capital T, and then this $1 will grow to e to the power of the spot rate between time small t and capital T in dollars times the time horizon between small t and time capital T. Now, instead, you could also exchange that dollar into 1 divided by ET numbers of the foreign currency. So let's say Swiss francs. Then you can take these Swiss franc and invest them at the Swiss interest rate. That means that this will grow to 1 over E times e to the power of RF, that's that interest rate in Switzerland, times the time horizon. So since we know back at time small t that we will receive this many Swiss francs for sure, because again, this is a risk-free investment. We know exactly the $1 can be exchanged to this many Swiss francs, and we know exactly by the risk-free interest rate in Switzerland, you're going to end up with this much Swiss francs. So since this is a risk-free amount which I can receive, I can back at time t lock in the forward exchange rate to exchange this many Swiss francs to a dollar amount of the forward exchange rate times the number of Swiss francs which I have. So therefore, this is a risk-free investment of $1 into this many dollar in the future. So since we have two different ways to invest that dollar, and both are risk-free, this means both of these approaches have to yield exactly the same dollar amount by no arbitrage. And this pins down the forward exchange rate. F, the number of dollars which you have to pay per Swiss franc at that future maturity date, will be equal to the current exchange rate times e to the power of the difference in the interest rate between the US and Switzerland times the number of years left to maturity. Notice that if the forward exchange rate was larger than this right-hand side, that would mean that investing $1 into Swiss franc and then investing in Switzerland, exchanging back to US dollar, yields a higher dollar amount than directly investing the $1 at the US interest rate. And then the arbitrage strategy would be borrow $1 in the US bond market, and with the promise to pay back this amount of money, take that US dollar, exchange it, invest it in Switzerland, and then lock in the forward exchange rate, exchange it back to US dollars. Similarly, if this forward exchange rate was less than this right-hand side formula, then it means that this dollar amount is larger than this dollar amount, and therefore we would want to borrow 1 over E Swiss francs and lock in the exchange rate to exchange this many dollars into Swiss francs to pay back that borrowed money. And we take that borrowed Swiss franc, exchange it to $1 and invest it in the US market to earn this many US dollars. So again, this thing larger than that means I would then get a positive payoff. And again, this is an arbitrage. The same argument is also on slide 28 in our lecture notes. Notice that if we look at this formula for the forward exchange rate, this is actually exactly the same formula as what we had for an asset which pays a dividend yield. The difference is just that I replace the current price S by the current exchange rate, and instead of using the dividend yield Q, I use here the interest rate in the foreign currency. This makes a lot of sense that these formulas are equivalent, because basically holding a foreign currency means that you invest that foreign currency in the foreign risk-free market, and therefore this foreign currency earns you a cash flow yield which is exactly equal to the interest rate in that foreign market. So therefore, holding a foreign currency is really basically the same as holding an asset which pays a dividend. So consider again the example where we had the spot exchange rate of $1.03 per Swiss franc and the forward exchange rate of $1.035 per Swiss franc. Now, what does this imply about the relationship between the US interest rate and the Swiss interest rate? Well, basically, you just take this formula over here, you plug in 1.035 and 1.03, and then you solve for that difference in interest rates. And what you're going to end up with is that the US interest rate has to be 0.97% higher than the Swiss interest rate if both interest rates are in continuous compounding. Now, as a second question, what would the forward exchange rate have to be if the half-year spot rate in Switzerland was minus 0.75% quarterly compounding and the half-year spot rate in the US was 0.5% quarterly compounding? Well, then either we can use this formula over here and first convert the quarterly compounded rate into continuously compounded rates and just plug in, or we can derive an equivalent formula for directly quarterly compounded rates. Now, how would this argument go? Well, if we draw again the timeline from small t to time capital T, and we have now m times compounding, then again, $1 invested in the US market will grow to 1 plus the US interest rate divided by m to the power of m times the time horizon dollars. Or again, we can convert that into Swiss francs, 1 over the spot exchange rate, then invest that in the Swiss bond market, and that will grow to 1 over ET times 1 plus the interest rate in Switzerland, m times compounded to the power of m times capital T minus small t. And again, you can convert that at a fixed forward exchange rate back into dollars. And therefore, again, because both of these cash flows are risk-free and in US dollars, this has to be equal by no arbitrage. And you have the forward exchange rate is equal to the current exchange rate. Now, instead of using the continuously compounded formula with the exponential function, we have now 1 plus the interest rate in the US divided by m to the power of m times the time horizon divided by 1 plus the risk-free rate in Switzerland divided by m to the power of m times the time horizon. So going back to this question, now we can just plug in the current exchange rate, again, is $1.03 per Swiss franc. Now we plug in here the US interest rate of 0.5% quarterly compounded, here minus 0.75% quarterly compounded, and the entire thing to the power of 4 times compounding per year for half a year time. That gives you now a forward exchange rate of 1.0365 US dollar per Swiss francs. Notice this is not a typo that I use here, a negative interest rate. Actually, in recent times, specifically since the global financial crisis in 2007, 8, 9, we have actually seen a few governments which had very aggressive monetary policies and interest rates dropped to a negative territory. And in particular in Switzerland, this was quite striking because even 10-year bonds, and not even just government, but also bonds from like big corporations like Nestle, for example, had negative yields. So meaning if you lend money to either the Swiss government or a company like Nestle, they actually would promise you to pay back less than the amount which they have borrowed. Now let's look at another example which is more motivated by real events. In particular, we want to look at the sovereign debt crisis in Europe. So after the global financial crisis in 2007, 8, 9, a lot of governments in Europe actually had a lot of debt and made a lot of losses. And in particular, Greece was one of the countries which stood out and which was very close to default. Now, because of the way the European Union and especially the Eurozone is organized, they don't actually want to allow for default of one of its member countries. So basically, the choice was that either the richer countries, and in particular Germany, and to some extent also France, would have to make some big transfers to bail out Greece, or the Eurozone may actually, and maybe also European Union would split up, which then could have some other disastrous consequences for entire Europe. Now, during this time, the euro started to weaken a lot because people didn't want to hold the euro because of all this uncertainty. And a lot of people started to invest in Swiss francs. Now, this meant that the Swiss franc started to appreciate a lot against the euro. And this was bad news for Swiss companies which produce in Switzerland but wanted to export their goods to the European Union. Because again, if the Swiss franc becomes relatively more expensive, now these companies have a much tougher time to pay their salaries and all the production costs in Swiss francs and still stay competitive and sell at a relatively low price in euro. At this time, in order to protect the Swiss economy, the Swiss National Bank started to intervene and they made an announcement that they said they are committed to sell Swiss francs and buy euros to stabilize the exchange rate at 1.2 Swiss franc per euro. So basically what they said is they will do whatever it takes to make sure that the Swiss franc doesn't appreciate more against the euro. Now the Swiss National Bank was pretty credible at the time, and so everyone believed that they're really going to do whatever it takes, and therefore the exchange rate really stabilized at 1.2 Swiss franc per euros. Now, at the time, it was still true that the interest rate in Germany was higher than in Switzerland. So let's take as examples a 1% continuously compounded interest rate in Germany versus a 0.025% interest rate in Switzerland. Now let's take a statement by an analyst at Credit Suisse who says that, well, since we know that the Swiss National Bank does whatever it takes to stabilize the exchange rate, well then the euro in 3 months' time should be the same as the current exchange rate, and therefore also the forward exchange rate should be the same as the current spot exchange rate. That means equal to 1.2 Swiss franc per euros. Now, as a side note, on January 15th, 2015, so 3 years after they started imposing this policy, the Swiss National Bank actually surprised the market and announced that it will no longer support the exchange rate between Swiss franc and euro. And within just a few seconds, the Swiss franc sharply appreciated by about 20% and ended up at 1 Swiss franc per euro. So this showed that the Swiss National Bank wasn't that credible after all. Now, but let's go back to the time where we thought that the Swiss National Bank was credible, and let's consider again that statement by this analyst at Credit Suisse. So does this statement make sense, yes or no? Well, remember that the forward exchange rate, or for that matter, any forward price, is actually determined by a no arbitrage argument. So it has actually nothing to do with what we expect to happen to the underlying asset in the future. So therefore, this argument by this analyst seems somewhat flawed because, again, he is arguing that the forward exchange rate should be the same as the current exchange rate because we expect the exchange rate not to change in the future. So one way to prove this analyst wrong is we can use our no arbitrage relationship for the forward exchange rate. And the forward exchange rate, according to what we have derived before, should be equal to the current exchange rate times this differential between the Swiss and the German interest rates times the time horizon over which you invest. So this means we have 1.2 Swiss francs per euro, that's the current exchange rate, times e to the power of the 0.25% which you earn in Switzerland minus the 1% which you earn in Germany when you invest euros times 3 months. And this gives you a forward exchange rate of 1.19775 Swiss franc per euros. So meaning that the forward exchange rate actually suggests that the Swiss franc will be more valuable than the euro. Now, if the forward exchange rate was indeed 1.2 Swiss franc per euro, then we can actually lock in an arbitrage profit. So what do? We want to borrow money in Swiss francs, let's take 1 billion Swiss francs, at the relatively cheap interest rate of 0.25%, exchange it into euros, and how many do I get? I get 1 divided by 1.2 billion euros, then invest these euros at the German interest rate of 1%, and we sign a forward contract where we lock in the exchange rate to exchange this many euros back into Swiss francs. So again, if the forward exchange rate is 1.2 Swiss franc per euro, I can convert that back into e to the power of 1% times 3 months, billion Swiss francs. Now today, all the money I borrow, I exchange and reinvest, therefore the cash flow is zero. Now in 3 months' time, I receive the euros, I exchange them at the fixed forward exchange rate into Swiss francs, and this amount of Swiss francs which I have now is more than what I have to pay back for the billion Swiss francs borrowed at 0.25% for 3 months, and therefore I have an arbitrage profit of 1.878 million Swiss francs. And again, this is risk-free. Now, it is still true that as long as the Swiss National Bank ensures that the Swiss franc doesn't appreciate, meaning that the exchange rate cannot drop between 1.2 Swiss franc per euro, then it is actually now profitable to take long positions in these contracts where we lock in to pay 1.19775 Swiss francs per euro and then just exchange them back at 1.2 Swiss franc per euro. So therefore, if we do that, if we always take these speculative long positions in this forward exchange rate, then we can always collect a little bit money at a time. Now, of course, this works until to January 15th, 2015, where suddenly the S&P made this announcement and the Swiss franc appreciated a lot, and effectively the exchange rate jumped to 1 Swiss franc per euro. And then with a long position, where you locked in to pay 1.19775 Swiss franc, then you lose a bunch of money. And that's what happened to a lot of currency traders at that time. So far, we said that by no arbitrage, the forward exchange rate has to be equal to the current exchange rate times this exponential function of the differential between domestic and foreign interest rates times the time horizon, which we also call the covered interest rate parity. And again, I write it here in a slightly different way. I just bring the current exchange rate on the other side. And if you look at this relationship, then this holds pretty well in the data until the financial crisis starting in 2007. So in particular, in this graph down here, what we look at is the difference between this ratio and this right-hand side differential of these interest rates. And so as long as there is no arbitrage opportunity, the difference between left and right-hand side in this equation should be very close to zero. And indeed, if you look at the data, these differences for many different currencies was indeed very close to zero. However, during the financial crisis, so between here and about this point in time, we had quite large deviations of this relationship. So implying that there were actually arbitrage profits. Now, during a crisis, a lot of weird things can go on, and it could just be the case that a lot of people couldn't really borrow money, and so they couldn't implement this kind of arbitrage strategy. And so we say that, well, okay, that we have all these deviations from this covered interest rate parity. That may be not that much surprising during that global financial crisis. However, the surprising thing is that anytime since the crisis, we still observe quite a lot of these deviations of the CIP. So meaning that there seem to be still arbitrage profits out there in these foreign exchange markets. Now, there's a very beautiful academic paper, and we also base our midterm exam on that academic paper, which shows that these deviations in the CIP since the financial crisis are most likely due to the increased capital requirements by large banks. And the argument is the following: if there are deviations from that covered interest rate parity relationship, then it was typically before the crisis, it was the large banks which were able to trade on these deviations and earn small arbitrage profits. Now, since there are bigger capital requirements, if you want to trade and lock in an arbitrage profit, then you still have to enter a lot of positions in derivative markets and the spot exchange rates. And this will cause your balance sheet to become much bigger. Now, bigger balance sheet means because of capital requirements, these banks have to hold much more safe assets. So for example, treasury bonds. But for a bank, it is very costly to hold a lot of safe assets because that's capital which they cannot use for other operations. And therefore, even though there are arbitrage profits out there, if there are only a few basis points large, then it may still not be profitable for these banks to put aside so much capital to lock in these arbitrage profits. And so the argument, therefore, is that since after the crisis we have higher capital requirements, then these banks are not so active anymore to lock in arbitrage profits, and therefore we see more deviations from our no arbitrage formula. However, again, even though there are these deviations, it is actually not attractive enough for any market participants to lock in these profits. And this is actually a very good example of limits to arbitrage, of like constraints which are out there which don't allow people to actually lock in arbitrage profits. A second thing which I want to talk about in the connection with foreign exchange markets is the uncovered interest rate parity. And the uncovered interest rate parity, in contrast to what we have seen before, this no arbitrage relationship, is actually a relationship about what people expect to happen. In particular, the uncovered interest rate parity, or short UIP, that says that we expect the change in the exchange rate to be exactly equal to the interest rate differential between domestic and foreign currency. In other words, the UIP says that if the foreign interest rate is much higher than my domestic interest rate, then it must be that I expect the foreign currency to depreciate against the home currency, such that I'm the same well off investing at the higher interest rate in the foreign currency versus investing at the lower interest rate in the home currency. So what I earn more from investing at the high interest rate in that foreign currency, I lose again by my expectation by how much that foreign currency depreciates in value against my home currency. Now, a large literature in academia shows that the UIP doesn't hold in the data. Moreover, a lot of currency traders in practice actually borrow in low interest rate currencies and lend in high interest rate currencies, and they earned a lot of money doing this. In particular, this strategy, which we also call the currency carry trade, is more profitable than investing in stock markets. And if you invest in an equally weighted portfolio where you borrow in a few currencies which all have low interest rates and lend in a few currencies which all have high interest rates, then you can achieve a Sharpe ratio of about 0.6. So the Sharpe ratio is the expected return over the risk-free asset divided by the volatility of the strategy. Notice that for the stock market, this number is historically more something like 0.4 to 0.5. In addition, if you would optimize this currency carry trade, then you can actually even earn a Sharpe ratio which is well above 1. So meaning about 2 to 3 times as much of what you can earn in the stock market. And I do have some papers written on that as well. If you're interested, you can go to my website and look at these papers. Now, a lot of hedge funds got actually very rich trading in this currency carry trade. Now, nowadays, in developed currencies, we see that interest rates are basically all very close to zero. So nowadays, implementing this currency carry trade in developed country currencies is kind of hard because you really don't earn much of an interest rate differential. However, what investors did is instead they focus now on emerging or frontier markets where you still have very big differences in interest rates. One caveat of investing into emerging or frontier markets is that there might be some default risk. So for example, imagine lending to the Argentine government. Yes, the interest rate is much higher. And so if you would borrow, let's say in Swiss francs or Japanese yen, and investing in Argentina, then yes, you would collect a very high interest rate differential. However, from time to time, Argentina goes actually bankrupt, and then you may lose some money. So if you pick emerging market and frontier market currencies, you still want to be sure that you pick some currencies where you don't really have default risk. Now notice that the currency carry trade tells us that you want to borrow money in low interest rate currencies and invest money in high interest rate currencies. That kind of implies that you need to be able to borrow at very good conditions, which again would be maybe very hard for small investors and is maybe more attractive for, let's say, big financial institutions. However, there is actually an easier way to also implement that currency carry trade without actually physically having to borrow and lend money. In particular, you can do that with forward exchange rates. It turns out that if you enter a long position in a forward exchange rate, then this is equivalent to borrowing in your local currency and lending money in that foreign currency. To illustrate that, suppose that you borrow X dollar in your local currency at the local dollar interest rate, and you convert these dollars to the foreign currency into X divided by the spot exchange rate E, number of foreign currencies, and you invest that at the foreign interest rate RF. Now, what is your profit? It's going to be how much money you have invested times the interest which you earn in that foreign currency, and then converting that back at the spot exchange rate at this maturity date, capital T, which again, there is some uncertainty about that, minus the borrowed amount of money in dollars plus the interest in the local currency. Now, I can also rewrite that by factoring out X divided by the current spot exchange rate times that interest earned in the foreign currency. And if I do that, I have that constant amount of money times the spot exchange rate at the future date T minus the forward exchange rate. And notice that this difference is exactly the payoff of a long position in a forward exchange rate contract. Therefore, the currency carry trade is now very well accessible even to small traders like you and me, where again, if you want to, let's say, borrow in low interest rate currencies like Swiss franc and Japanese yen and lend in higher interest rate currencies like Australian dollar and New Zealand dollar, then we can take short positions in forward exchange rates of Swiss francs against Hong Kong dollar and Japanese yen against Hong Kong dollar, which is effectively borrowing Swiss franc and Japanese yen and lending in Hong Kong dollars. And then we take long positions in Australian dollars and New Zealand dollars against the Hong Kong dollar, which is effectively borrowing Hong Kong dollars and lending Australian dollars and New Zealand dollars. So you see that the lending Hong Kong dollar and borrowing Hong Kong dollar part drops out, and eventually I end up by just borrowing Swiss franc and Japanese yen and lending in the higher interest rate currencies of Australia and New Zealand. Finally, I want to discuss our no arbitrage arguments in the context of consumption assets. So previously we were considering investment assets, which investors just hold for pure investment reasons. So basically you buy an asset, you hold it for some time, and you don't actually care about what happens in between. You just care about the price at which you can resell it in the future. Now, in that case, we said it is pretty simple also to short sell these assets, because if you want to short sell, you just go to someone who is a long-term investor, and this guy is going to be willing to lend you that security, and you can short sell it and then return it later to that lender. For consumption assets, the situation is a little bit different, because it might be very hard to borrow these assets in order to short sell them. So let's take, for example, orange juice. Let's say you want to short sell orange juice, and you know that I have orange juice at home in my fridge. Then you will come to me and you would say, Thomas, can you give me some of your orange juice? I promise I return it to you in 1 month. And then I would say, well, no, I don't really want to do that, because, you know, I have that orange juice in my fridge because I want to consume it tomorrow for breakfast and the day after and the day after and so forth. So it's really no good for me if I give you my orange juice now and you just return it to me after 1 month. So in that sense, it is a little bit harder for you to short sell this thing. And if anything, I would only allow you to short sell it in return for some fee. Now, what does this mean for our no arbitrage relationship? So consider again the case where the forward price is larger than the formula which we have derived before. So this strategy involves buying the underlying asset, taking the short position in the forward contract, and borrowing some money up front. And of course, dealing with these intermediate cash flows accordingly. Now, this is still possible even if it is a consumption asset. I can very well buy orange juice and store it and just pay the storage costs along the way. So again, the forward price can never be larger than this right-hand side. Otherwise, there is an easy way to implement an arbitrage strategy. Now, how about the case where the forward price is less than this formula over here? Well, in this case, we said you actually need to short sell the underlying asset, and then you use a long position in the forward contract to lock in the price at which you can repurchase that underlying asset to close your short position. And you, of course, invest the money which you get from short selling the asset. Now, the problem here is now with a consumption asset, you may not be able to short sell that underlying asset, or you can only do that at some rental fee. Well, then it is very possible that the forward price is smaller than this right-hand side expression, and yet no one can actually make an arbitrage profit. Therefore, we're going to end up with the weaker inequality, where the forward price is either equal or less than the price of the underlying asset, discounted by the dividend yield, and multiplied by the gross return of the risk-free asset until to maturity. And similar argument applies for discrete payoffs, where we say now the forward price is less or equal to the price of underlying asset minus the present value of all the cash flows during the lifetime of the forward, and multiply this entire thing again by this gross return of the risk-free asset. So then how do you determine the forward price? Well, we have an upper bound, but really to determine the forward price, we have to use some equilibrium argument based on what is the demand and the supply for underlying asset and what is the demand and supply in this forward market, and that would then pin down this relationship between the two prices. This is a little bit more tedious and more complicated than the no arbitrage argument, because now you need to make assumptions about what investors are in the market, why do they hold this underlying asset, what preferences do they have, how much wealth do they have, and how do you aggregate this entire thing to make markets clear. So eventually it will go back to something like a CAPM model, where you have an equilibrium condition which pins down expected returns. Now in the following, I want to do two things. First, I want to introduce something called the cost of carry, and that's denoted by C between small t and capital T, and that's the interest rate minus the intermediate flow of payments Q, where Q is some income which you receive minus the storage cost. Again, if Q is positive, basically you get a dividend yield. If Q is negative, basically you have to pay some cost for holding the asset. And then what I do is I say, look, I plug C in here for R minus Q. And then I said, now I want to recover here an equality. And how can I do that? Basically, I can subtract a certain number from this exponent to reduce the size of that right-hand side until it is exactly equal to that forward price. And that thing which I subtract, that's what I call the convenience yield. And the convenience yield is really nothing else than the rental fee which you have to pay for short selling that underlying asset. Now again, how do you determine that convenience yield? Well, it will have to be determined in some equilibrium model depending on demand and supply, how many people actually own the underlying asset, how many people want to borrow it. And again, this is a much more complicated model. But if we assume that we know already what the rental fee is for short selling, well, then we can actually use again a no arbitrage formula. Let's look at an example here. We have corn and the current price of corn on June 4th is $5.63. And then we assume that the cost of holding corn is 2% of its current value. And in particular, we assume that this cost is due at every instant point in time. So it's kind of a flow of cost which you have to keep paying all the time. Suppose then you can also enter into a forward contract to trade 10,000 bushels of corn in 18 months, and the forward price of corn is $5.24 per bushel of corn. Then we also assume that the 18-month spot rate is 0.5% per year. And the question now is, let's suppose that there's no convenience yield, so you basically can short sell corn without any costs. Is there an arbitrage opportunity, yes or no? So if there was no cost of short selling corn, then we know that the forward price should be equal to the current price of corn, this $5.63, times e to the power of the risk-free rate of 0.5% minus, and now be careful, Q is actually equal to minus 2% because it's a cost which you have to pay. So you have minus 2%, or in other words, this 0.5% plus 2% times 18 months. And this gives you a forward price of $5.85 per corn. Now, what does it mean if the forward price in the market is less than the price which we should have in theory? Well, if you can short sell corn, you would like to short sell corn, and you would like to lock in to buy back that corn in the future at that relatively cheap price to close out that short position. Now, I would like to write down this example a little bit more in detail, and the reason is because we actually have some storage cost, and I want to show you how we actually deal with storage cost if you want to short sell the underlying asset. So let's suppose again that you can short sell corn if you like. So what is our arbitrage strategy? We would say short, not 1 bushel of corn, but e to the power of 2% times 1.5 years bushels of corn. This means today I receive a cash amount of the number of bushels which I short sell times the current price of $5.63. Now notice that short selling corn means that I borrow corn and I sell it right now in the market. But borrowing corn from someone is equivalent to tell someone that this person can give you the corn to store for him. And that means basically you can charge that other person the 2% storage cost on corn. So that means that if I short sell corn, I will receive 2% storage cost from the person who gives me that corn at that initial point in time. Now, this means that at every time when I receive a little bit of this storage cost, I can use that cash amount to buy back a little bit of corn again and already return that to the person who lent me the corn in the first place. And that means I gradually keep closing some of the short positions so that although I start out with e to the power of 0.02 times 1.5 units of corn, by keep closing out some of these positions over time until to the maturity date, I'm going to end up exactly with 1 short position in bushels of corn, which then is worth ST dollars at that maturity date. Now at this point, I'm also going to sign a long position in the forward with the idea that this is a promise that I can actually buy back 1 bushel of corn by paying that relatively low forward price of $5.24. Finally, we also lend an amount of money equal to the present value of the $5.24, which means I have a negative cash flow of this $5.24 discounted by the 0.5% interest for 1.5 years. And in the future, I receive exactly that lent amount of money plus interest, which is then $5.24. Now let's look at the cash flows. In the future, I have a 0 cash flow for sure. And today the cash flow is 60 cents, which is also equal to the difference between that theoretical forward price and the forward price in the market, discounted by 0.5% for these 1.5 years. Now notice that there is an arbitrage opportunity because we can short sell the corn. Now if there was a fee for short selling the corn, then my profit over here would be reduced by that short selling fee. And therefore we can now say that if the fair forward price is indeed $5.24, then the short selling fee for corn should account exactly for the 60 cents which I earn at time 0. And on slide 41, we actually work out what that short selling fee exactly is. So again, our formula with the convenience yield is this thing over here. We plug in the values for the forward price in that market is $5.24. Then the current spot price for corn, which is $5.63. The interest rate of 0.5%, the storage cost of 2%. And then what we are looking for is that convenience yield or that fee for short selling corn, and then multiply by 1.5 years until to maturity. So if we do that, we find that the fee is 7.3%. Now you may ask, why is there actually a fee for short selling corn? And if you think again about the question, currently we are in June and delivery of the contract is in December. And if you look at corn market, we do see some quite strong seasonality in corn prices over the year. So what I plot over here is the price in each month, January, February, March, and so forth. And what we do is we take the price in each month and divide it by the average price over the entire year. Now, of course, in some months, the price might be just randomly high. In other months, it might be randomly low. But if we do that for many, many different years and take an average across all that, that gives us then a pattern which shows that prices of corn are typically higher during like these late spring, early summer months, and prices in corn are always relatively low during the winter months. Now, why is this the case? Well, it turns out that the harvest of corn is in the winter time. And therefore, we have a lot of corn available during the winter months. And therefore, supply of corn is relatively high, which means that prices are relatively low. And in contrast, during the summer month, where we are far away from the harvest, supply will be relatively low, or the corn which was stored from the winter until to the summer, there has to be storage cost paid on that corn, and therefore it will be sold at a higher price, and therefore in equilibrium corn prices during this late spring, early summer months are typically higher. Now again, for our contract, we said we are currently in June, where we enter the forward contract, and delivery is going to be in December. So if I want to short sell corn, and I want to borrow corn from someone, and I promise to return that corn during December, then that lender of corn would tell me, well, yes, but I'm basically giving you corn during a very desirable month, where corn prices are typically high, and you're going to return corn to me during a not so desirable month, where there's a lot of corn in the market and prices are typically low. So for me to agree to lend you the corn for 1.5 years, yes, I'm going to pay you the storage cost for that, but you still will have to pay me a rental fee for that difference. And that rental fee, as we have calculated here, would amount to exactly 7.3%. Notice that net of costs, so you as the guy borrowing corn would have to pay 7.3%, but the guy who gives you the corn is still willing to pay you the storage cost of 2%. So net of the storage cost, you actually have to pay 5.3% per year to be able to short sell the corn. Now we can push these arguments of consumption assets a little bit further, and we can look at underlying variables which are not traded at all. Let's, for example, think about the temperature in a certain area or the rainfall in a certain area. You cannot actually trade that stuff. Or you can also think about what if something is not storable. For example, electricity is very hard to store, or it's very expensive to do so. And for these underlying variables, we cannot derive a no arbitrage forward price. Because again, even if the forward price deviates from our formula, where we would say it's equal to the underlying value today times whatever the risk-free interest rate pays until to maturity, and maybe discounting by some intermediate cash flows and convenience, that doesn't make any sense. Well, because you cannot trade or you cannot store that underlying variable. Well, then the forward price has to be fully determined in an equilibrium model. It then all depends on who wants to enter long and short positions in, for example, derivatives written on the temperature or written on rainfall or on electricity. And again, equilibrium models are not as beautiful as no arbitrage arguments, because in an equilibrium model, you have to assume what are the preferences of all the different investors in these markets and what is all their wealth and how do you aggregate all that stuff. Finally, I want to come back to the limits of arbitrage. Again, we said that no arbitrage formulas actually hold as long as someone could implement an arbitrage strategy if there is a deviation in the derivative price from the no arbitrage formula. However, if there are some constraints or, for example, liquidity requirements, then it might be just too costly or impossible to implement an arbitrage strategy, and therefore we can actually have deviations from our no arbitrage formulas. And one example was, again, what I already pointed out, these violations of the covered interest rate parity when we looked at foreign exchange rates. And again, this is also one of the subjects which we want to talk about in the midterm exam. Now, a real danger is that if you are an arbitrager and you see a deviation from the no arbitrage formula, and you think that there is an arbitrage profit to be made, and you're very aggressive to trade and try to lock in a lot of arbitrage profits, then the danger can be that maybe sometime down the road, but before the maturity date, before you actually realize your arbitrage profit, you may hit some constraints and you may be forced to early exit your strategy. And at that time, you may actually be left with large losses and may be unable to realize your actual arbitrage profits. Similarly, if you are a hedger and you kind of follow this theoretical concept of hedging, but you don't realize that there might be some financial constraints down the road, this can be equally dangerous, because if you hit some constraint before your hedging strategy is actually fully realized, then it might be that again you may have to realize some losses and you will be again fully exposed to some risk. Two examples of arbitrageurs who failed because they hit some financial constraints, even though they were quite sophisticated traders, are long-term capital management in the late 1990s and Lehman Brothers in 2008. Now, one very nice example of a company which tried to hedge risks and didn't realize that there are liquidity constraints was Metallgesellschaft, and we also have a case study on that. As a summary for forward prices, the forward price is going to be equal to the price of the underlying asset times e to the power of the cost of carry times the number of years left to maturity. And again, if we have an underlying asset which doesn't pay any dividend and it doesn't cost anything to hold that asset, and we are free to short sell that asset, then the cost of carry is just equal to the risk-free interest rate. If you have an underlying asset which pays a dividend yield or a storage cost, where then Q would be a negative number, then the cost of carry is just the risk-free interest rate minus Q. In the setting of foreign exchange market, the cost of carry can be written as the risk-free interest rate in the domestic market minus the risk-free interest rate in the foreign market. And if we have a consumption asset where you have to pay some short selling fee, which is equal to that convenience yield, and then we have the cost of carry minus the convenience yield here in this exponent for the formula for our no arbitrage forward price. Now, if we still would like to connect forward price and future expected price of the underlying asset, then we can still derive such a relationship, and that's what we're going to do on slide 45. To explain what's going on that slide, so let me illustrate this with a timeline from small t to time capital T. And what I start with is by looking at 1 unit of a risky asset. And if I reinvest all the dividends, and I will now also treat the convenience yield as a dividend until time capital T, then I end up with e to the power of the dividend yield plus the convenience yield times capital T minus small t number of years, units of the asset. Now notice that the price of this is ST dollars today, and in the future this is going to be worth the number of units which I have times the dollar amount for each unit of the asset. Now I want to introduce another variable called the expected return, which says that if I have $1 invested in this risky asset, this will grow to e to the power of the expected return of S from small t to time capital T times the number of years over which I invest is $1. So that means then if I multiply that by number S, then I get this many expected dollar amounts in the future. Now, since both ST dollars invested in the risky asset yields this many dollars, and I can write here also an expectation taken at time small t, and ST dollars invested in the risky asset, just written in terms of these expected returns, gives me an expectation this many dollars, then, well, because this is both the same dollar amount invested in the same asset, then these two expressions are by definition exactly the same. So this means I can now get a formula for the expected price of the underlying asset, which is equal to the price of the underlying asset at time small t times e to the power of risk-free rate minus dividend yield minus convenience yield times the time horizon times e to the power of the expected return minus risk-free rate times the time horizon. Now notice that risk-free rate over here, that cancels out with the one over here. And so this is really just going to be, again, the same equation as what I have over here. Now, why do I write it in this way? Why do I introduce the risk-free rate? Well, if we look at this thing over here, that's just the forward price by our no arbitrage argument. Now, if you write down the expected payoff of a long position in the forward, that's going to be, as a long position, you receive the underlying asset, which is expected to be worth this amount of dollars, minus the forward price which you have to pay. And if we divide that by the forward price today, this is basically the return which we make on the long position in the forward. Then this is exactly equal to the excess return. So that means the expected return of the risky asset over the risk-free rate over the time horizon between small t to capital T minus 1. So converting the gross return into a rate of return. What is the economic meaning of this? Basically, it says the left-hand side is the return on taking a long position in that forward contract. So what is a long position forward contract? It doesn't need any initial investment, and you're going to collect the expected return of the risky asset in excess of the risk-free asset. But then if you look at the right-hand side, this also tells you that this strategy is equivalent to buying the underlying asset and financing that by borrowing at the risk-free rate, which again earns the expected excess return of the risky asset over the risk-free rate. But then all this really says is that taking a long position in the forward contract is really economically equivalent to borrowing money and investing that in that underlying asset. The last thing of this chapter which I want to talk about is how does the value of a long or a short position in a forward contract change after the initial point where you entered the forward contract. To illustrate that, let's go again to the virtual whiteboard, and what I want to draw is again a timeline. And here we start at time small t, where you enter a forward contract and a maturity date capital T. And at time small t, you can take, for example, a long position in a forward, which then tells you that in the future, you're gonna get the underlying asset and you have to pay the forward price F. And let's denote this value of the long position by variable F, where we indicate the long position in superscript with long, and we indicate that you have entered the position at time small t and it will expire at time capital T. And we indicate the current time with the subscript small t, so we look at the value of that long position at time small t. So we define this as the present value at time small t of that payoff. And again, this is chosen such that it is exactly equal to 0 at time small t. Now the key question is, what happens at some time s between small t and time capital T? What is the value of that long position at time s? So of course, this is now the present value at time s of this future payoff of st minus the forward price, which you have locked in back at time small t. But this thing again is risky because st is not yet known. And so if you wanted to do like the standard present value calculations, then you would have to find the appropriate risky discount rate. Now in this course, we try to do as much as possible with no arbitrage argument. So we want to think about how can we find a no arbitrage argument to pin down the value of that long position without having to find a risk-adjusted discount rate to discount that risky cash flow S. And the idea is going to be the following. Well, at time S, we could also enter long or short positions with expiration date capital T. And this contract, in particular a short position, would mean that you will receive a fixed forward price, which is now determined at time S, and you have to deliver the underlying asset. Now again, this forward price F at time S is chosen such that the current value of that short position, which you have entered at time S, is equal to 0. But then what I can do is I can now form a portfolio of my long position, which I have entered at time small t, and which is now worth Fs today, plus a short position, which I just entered today, which I know is equal to 0. And I know that this portfolio, this combined position in the future will have a payoff which is exactly equal to the difference in the forward prices, which I lock in at time S, and the one which I have locked in back at time small t. Why is that? Well, because these risky cash flows from the underlying asset exactly cancel out by this combined position. But now I have something risk-free here, and this thing I can just discount back at the risk-free rate. So now I know that the present value at time S of just this difference of these two constant values is equal to that constant value discounted by the risk-free rate between time S and the maturity date for how many years are left between S and time capital T. Now this is equal to this combination of the long position which I have entered back at time small t and the value of the short position which I have entered at time S. But now again, the short position at time S has 0 value because that's exactly how we choose that forward price Fs. And therefore, now this entire thing is just equal to the value of the long position at time S, which I have entered back at time small t. So now I have a no arbitrage argument where I don't need to find some equilibrium risk-adjusted discount rate to figure out what is the value of my long position at time S, which I have entered back at time t. Notice that the long position in the forward contract has a positive value if the forward price at time S is larger than the forward price at time t. And if you go back here to the slides where we look again at the no arbitrage expression of the forward price, we see that for the long position to become valuable, to have a positive value, we need a sufficiently large increase in the underlying asset or a sufficiently large increase in the cost of carry, which means either the interest rate sufficiently increases or the dividend yield sufficiently decreases or the storage cost sufficiently increases or the convenience yield sufficiently decreases. On slide 47, here I just list again what is the value of the long position which you have entered at some previous time t, what's the value at time s. Again, that's just what I've derived on the virtual whiteboard. It's that difference between the forward price at time s minus forward price at time t, discounted by the risk-free rate, because again, this cash flow you only receive at the maturity date. Now, for the short position which you have entered previously, what's the value at time s? It's just going to be the opposite of the long position. So we are just going to flip whatever is in here in these parentheses. So now you want the forward price actually to be lower than the forward price which you have initially locked in. And this concludes our discussion of chapter 3.